So when there's a security, there's two choices. It gets registered with the SEC, which by that we really mean going public, spending millions of dollars, having a team of 50 lawyers, putting together an IPO, or they fall under an exemption. Regulation D is one of those exemptions, and it's probably the exemption that's used way, way more than any other. About 98% of deals use Regulation D over the other exemptions. So Regulation D lets you raise an unlimited amount of money from an unlimited number of accredited investors. And whether or not you advertise or take non-accredited investors, you could do one or the other.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Tilden Moschetti. Tilden is an investment, fund, and syndication attorney. And in just a minute, we're going to speak with Tilden Moschetti about Reg D Syndications. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Tilden Moschetti. Welcome to CRE Radio.
Well, thank you for having me, Darren. I'm very excited to be here, and I'm sure we're going to have a good talk.
Well, I'm glad you're here, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I went to law school really with the idea of being a real estate developer. And so that I got into law school, focused really on property and contracts and things like that. Got kind of swayed off that track a little bit when I took some advocacy courses and decided to be a litigator. Was a litigator for 10 years, but always still focused in real estate. So my clients I didn't do any evictions or anything like that. I focused on really when there was a dispute about the valuation of real estate. And so that's a very unhappy world. Whenever there's a litigation, there's nobody really happy on any side. And so I was kind of disgruntled. I discovered brokerage and was doing a little bit of that at the same time as litigating. And one of my brokerage partners showed me a deal, and he said, "Hey, look at this great deal. I think it's really good." I looked at it and I said, "Yeah, this really is a good deal." He said, "We should syndicate it." And I said, "Okay, that sounds great." Not really knowing what syndication was. That was about 11 years or so ago now. So we syndicated it. I put the deal together and it had to kind of figure out how to do it. But as a lawyer, it was like, okay, I should be able to do this. That deal turned out ultimately to be very successful, and did another. And I realized, well, I'm enjoying this part of my world. Why don't I just stop litigating and start helping clients put together syndications? And that's what we've been doing now for about 10 and a half years.
Awesome. Well, it's interesting to get your perspective from having been a litigator and can the other side, or I guess, from a different angle on real estate. And but then to find the syndication route, and you said a brokerage. Were you also a commercial real estate broker, or were you doing legal work for brokers, or?
Yeah, no, I was a commercial real estate broker as well. Did quite a few transactions, earned a CCIM. My what I really like is probably retail more than any other of the product types, and I still really just like that product type most today, though I've done syndications in pretty much every property type there is.
Got it. Got it. Well, that kind of brings us to our topic today, Reg D.
Yeah.
Um, for the listeners, maybe a good place to start is just define what is Reg D.
Yeah, the best place to start is what is a security. So a security is, well, anytime somebody is going to be raising money, so they're taking in investor money where they're going to be doing all the work and the investors are expecting to get some sort of return, that's a security. So when there's a security, there's two choices. It gets registered with the SEC, which by that we really mean going public, spending millions of dollars, having a team of 50 lawyers, putting together an IPO, or they fall under an exemption. Regulation D is one of those exemptions, and it's probably the exemption that's used way, way more than any other. About 98% of deals use Regulation D over the other exemptions. So Regulation D lets you raise an unlimited amount of money from an unlimited number of accredited investors. And whether or not you advertise or take non-accredited investors, you could do one or the other.
Got it. And and just to be clear, the Reg D does apply to all types of investments, or is it limited to?
Yeah, I mean, about 80% of my business is real estate syndication, but the other 20% is just businesses raising capital for themselves or people trading cryptocurrencies or mining cryptocurrencies or putting together investment funds that are all sorts of different things.
Got it. Got it. But it all falls under security. It's just a matter of these aren't necessarily publicly um, registered. Is that the difference in?
Exactly. It's not registered. It is filed with the SEC, but it's not registered. They don't actually review those the filing.
Got it. So you mentioned the kind of the who you can invite, accredited, and then some others. What are there variations of the Reg D? Is that?
Yeah, there's really two rules. In reality, there's three, but really two are used today more than any other. So we have Rule 506B or Rule 506C. Those are the actual code numbers that are being used. So Rule 506B lets you raise still that unlimited amount of money, but you can take non-accredited investors. You can take up to 35 in any 90-day period. The caveat is you can't advertise, which really translates to you need to have some sort of relationship with each of those investors ahead of time. The other rule is Rule 506C, which lets you raise, again, from an unlimited amount of money, from an unlimited number of accredited investors, but they have to be accredited, and we actually have to verify that they're accredited investors before they can come in, and there's no non-accredited investors.
Got it. And for the listeners, a quick reminder of what an accredited investor is.
Yeah, an accredited investor there's two tests for it. It's either under the income test, it's somebody who makes $200,000 or more for the past 2 years and expect to make that in the current year. It's $300,000 if they're including the income of a spouse, or under the net wealth test, which is over $1 million of net wealth, which does not include the value of or any equity in the family residence.
Got it. Got it. So, is there a reason why a syndicator would choose to use a B or a C, or is it just kind of like you said with the network?
Yeah,
Depending on the size.
it starts with your network. I mean, it starts with where your investors are coming from. So if I have a huge network and I kind of know everybody and I know everyone who's coming into my deal, I'm just going to choose Rule 506B. because I don't need to verify that they're accredited investors. I don't have to go through that extra process. I can just take their word for it and bring them in. If I don't know everybody that's there, I'm probably going to use Rule 506C because I need to get the word out to all these other people who may come into my deal. So I have to advertise. There again, I have to verify they're accredited investors. It is also possible to go from 506B, so raise amongst my entire network, bring in some non-accredited investors, and essentially close that off, finish the raise period itself, and then reopen it again later under Rule 506C. And at that point, then nobody with the non-accredited is coming in anymore. People who are there are already there. But then I can expand that reach and advertise.
And do you find that it typically, I mean, obviously the size of your network would probably, dictate a lot of which way you're going to go. But do you find that there's a capital raise size that tends to lean one way or the other, or is there a line where you see people making
Yeah,
the
I mean, I'd
decision?
say probably over 5 million. Most people are doing a 506C at that point. It's not really rules driven because I've certainly had people do 506 C for raising 1 million. So and I've had people do 506B for 20 million. I have one client who has a very large network of very wealthy people, and so you know his raises can easily be 20 million, but he knows everybody that's coming in, and so there's no reason to put it under 506C.
And for the B, is there any kind of a test of knowing someone?
There isn't a real test that's ever been handed down. What the courts ultimately look at when it needs to decide these things is they look at the person in front of them and they say, does this investor, do they have a relationship with the syndicator enough that they could call them on the phone and ask them even a stupid question and get a good answer for it? Like, do they have that level of trust already there? And then on the other hand, does the syndicator know that investor well enough that they have a reasonable idea on whether they're sophisticated, whether they know what they're doing by getting into this investment? So those are the two kind of questions that the courts deal with and they kind of grapple with when they're deciding whether or not this is somebody who is properly under 506B versus in a 506B.
You mentioned courts and grappling with this. Um, as long as I've been doing this, I've talked to people about syndications. Um, Rarely have I ever, if I don't think I've ever talked to anybody that's actually admitted to or uh, discussed having a syndication that's gone to court.
Yeah.
Um, is that something you have dealt with? Is it something you've seen? Is it?
Fortunately, it's super, super rare. And it's super rare if people have done the right thing, right? If they've done all the documents that need to be done, they've filed everything with the SEC, everything looks really good. The way this comes up, so the way an action gets brought up in the world of syndication is somebody gets mad, they file a lawsuit. When they go to file that lawsuit, the first thing the plaintiff's attorney says is, well, show me the PPM. If there isn't a PPM or a private placement memorandum in existence, that's going to be a red flag. It's going to let the plaintiff's attorney know, okay, maybe I have a case because now this document, this private placement memorandum, the document that says you could lose all your money never existed. So there's a good chance that the plaintiff in this case or the investor could win because they probably weren't told all these things of the risks that just are naturally there. So that's the reason that we generally don't see a lot as long as a PPM is in existence. The other thing that they're really looking for is like, was a Form D filed with the SEC? Because if it was filed with the SEC, chances are it's going to be a pretty well structured deal. It probably is safely under Regulation D. If it wasn't filed, the plaintiff's attorney is thinking, okay, this may be a case where I can call this investment a what we call a public offering, which is public offerings have to be registered, whereas the Regulation D moves everything underneath that private offering umbrella. And so that's what they're kind of thinking when they're trying doing it. Otherwise, I mean, they'll take somebody's money, but paying $100,000 or more to get it ready to be in a lawsuit is just not likely to happen from a plaintiff if if they know they're going to lose, right? I mean, if
Yeah.
they signed a document that basically says, "Yes, I was told that I could lose all my money," well, if they lose all their money and they've signed that, it's unfortunate and it's terrible, and it doesn't happen a ton, but they knew that it could happen.
Right. Right. You were aware.
Yeah.
Um, so the 504 is under, is that the Securities
Yeah, so
Act?
504 is kind of dead. I
Okay.
mean, it still exists in the world, and but mostly it's a lot more complicated of a rule. The rules got rewritten in about 2007, and so that's when we really saw Rule 506C kind of take off and allow this advertisement of non allow this advertisement for accredited investors. That's what people were generally using 504 for. The problem with 504 is every state's rules also gets kind of dragged into this process. And so what a 504 offering needs a review not only under the security rules of Rule 504 and all of Regulation D, but it also needs now every state where your investors come from's rules analyzed as well. So it just added a lot of complexity, a lot of cost. That's why people just generally don't use it anymore.
Got it. So the 506 or the B or C is kind of
That's what we
the
use. Yeah,
standard. Okay. And was that the Jobs Act? Was that what that came out of?
yeah, exactly.
Okay. Okay. All right. So you want to syndicate something. What all do you need to do to file a 506B or a 506C?
So there's really kind of some main documents that go into existence. Now, they all exist in the framework of we need an entity in order to do this, right? There's something there that investors are investing their money into. Most of the time, certainly in the real estate world, that's an LLC, right? So I call that the investment entity. So the investment entity itself has an operating agreement, which is the rules of how it's going to work. The other document that is almost always there, and certainly there under Rule 506B, is what we call a private placement memorandum. So that's a document that describes the risks, the conflicts of interest, the general terms. It kind of simplifies or makes readable the operating agreement so it's understandable for investors, and lets them know that this is an investment. It's a risky thing. We're going to do our best to make money, and here's how we're going to try to make the money. So that's another document. The third document that's pretty critical is that subscription agreement, and that's where your investor basically says, "Okay, in exchange for $100,000, I'm getting some ownership of that LLC."
Got it. And so with those three documents, the operating agreement, the PPM, and the subscription agreement, are all of those filed with the SEC, or is it just
Yeah.
one?
So then what gets filed ultimately with the SEC is a form. It's called Form D, like dog, or like Regulation D. And it basically asks really just some preliminary stuff. It asks, well, if there is a problem, who do we contact? How much money is being raised? What rule is being relied upon here? And it's used a lot for statistical purposes for the SEC to kind of know what's going on, but also so if there is a lawsuit or a complaint that comes in, they know what category to put it in, right? They know who to talk to within the SEC, and the SEC then knows who to reach out to say, hey, we've received a complaint. we're going to begin investigating.
So to that, with the SEC, you register a syndication with the SEC. You file your Form D. You've set up the investment entity. You've got your operating agreement, your PPM, and your subscription agreement. You go out, you raise some money. Something doesn't. Somebody gets unhappy. I mean, essentially, is what it comes down to. When the SEC gets notified, is there much of a are they do they have teeth or is it a prosecution type thing, or is it more of
Yeah,
just it's
the SEC
registered?
has. Yeah, I mean, look at it again from the perspective, it's a plaintiff's attorney who filed the case so that the SEC gets notified. Once the SEC is notified, the plaintiff's attorney is delighted because now it's the SEC attorneys that are going to go after this. I mean, they're going to spend most of their time prosecuting the case rather than the plaintiff's attorney gets to sit kind of back because his case is pretty much won. As soon as the SEC wins, he's done. He's getting a nice payday. So if the SEC does investigate, they do these things. States also do investigations and also will prosecute as well. And there's probably more prosecutions that take place at the state level than at the SEC level.
Got it. And is that the state where the LLC is domiciled? Is that the state where the property is located? What typically governs the
Most of the time, so part of the rules say that Regulation D preempts all state rules, but states have the right to be notified. So we call that part of the state's blue sky laws. So the individual states where the investors come from are all notified that, hey, we've got this offering that went out. The action that the state regulators take typically is on behalf of their investor. So if somebody is in this state, that state will file the action in their state because it would be violating whatever sort of rules in order to protect its people.
Got it. So a syndicator goes out and uh, they follow all of the guidelines. They got their investment entity, their operating agreement, their PPM, and their subscription agreement. They go out and they raise some money, make a make an investment. Um, they do everything like they said they were going to. Um, how often are we talking about something that you have seen where the documents get challenged and somebody's upset?
Hardly ever. So maybe I'll have one client every other year with an investor who's unhappy. Um, and it's oftentimes not even that they lost money, right? So normally it's something else going on, or the investor really needs to get their money back because they have a life event that requires it, and this is a very illiquid asset, so it's not easy to just give somebody their money back. That's normally what's going on, and when somebody is unhappy, normally there's some solution that can be brought to that can be reached in order to basically get that unhappy investor to a place where they're not as unhappy, so that nothing goes forward. It's pretty darn rare that maybe I'll hear from a state regulator. Like, I don't know, I've probably heard like 3 times in 10 years from a state regulator, and then it's just a question. Normally it's, hey, can you send us this so we can see what's going on? And the answer is always sure, absolutely. And here you go, because we want to keep them happy. So but it's
Uh,
pretty rare that we have something go to court.
right. No, and it makes sense. I mean, you've raised the bar enough to if you're going B, you're probably working with people that are closer to you. Um, you probably know a little more intimately. Whereas C, you've established the test that they're accredited. And I was going to ask you, is the cost to do a C, is it dramatically greater than doing a B?
From my side as an attorney, I charge the same between the two. The work is substantially similar. The there is a slight additional cost of verifying that somebody is an accredited investor. That's not something my firm does. There's third-party resources that do it. And generally, they charge between $60 and $70, sometimes as much as $80 to verify that they're accredited. So there's a slight increase in cost more. Sometimes the investor pays for that, sometimes the syndicator does.
Okay, but it's not like inordinately
It's not
greater than,
thousands.
yeah,
No.
yeah. Got it. Got it. So if somebody comes to you and wants to syndicate a deal and they say, hey, we've got this great investment. We've got, we've been talking to people. We want to get this done. What kind of a timeline are you looking at if somebody, comes to you with, or when do you encourage people to engage you, and how long does it usually take to create the documents needed?
I get brought in really at any point where the syndicator knows, hey, I'm going to go forward with this no matter what. It's not important to me if the deal changes from buying 123 Main Street to 456 Second Street. So it's not a substantial rewrite. It's not there's nothing, there's nothing major going on for me to change those. So I prefer it that I get brought in early to the process because I can help structure the deal. That's one of the kind of value adds that I have for my clients is being able to help them structure the deal and set the fees and kind of the expectations right before they're talking to investors. So I like it before they even, put a property under contract. But I have a number of clients that wait until it's under contract. And I have some clients who even wait until due diligence has been waived. That kind of shortens their window from raising money. But if it's something that has that long contract period, that's fine. I'm really generally pretty flexible. It's really whatever the client wants. My turnaround time is 2 weeks, which I think is extremely fast in the biz. But it's just because all we do is Regulation D.
Got it. And it just occurred to me I should probably differentiate. A syndication is different than like a fund where somebody's raising capital to go purchase multiple
Really?
assets.
Yeah, not
Uh,
really. And
no?
so, as a matter of law, there is no distinction whatsoever. So, generally, people think about a syndication as being for one asset and a fund being for multiple assets. And so, the documents themselves look pretty similar, whether it's one asset, if it's 123 Main Street, or because there we can describe it with a lot more specificity. Or if it's a fund, it may say something, we're going to buy these kind of buildings in this kind of location with these funds. So they'll change subtly like that, but not in a huge substantial period. They certainly are a little bit different if we're talking about a fund where it's we're gonna raise some money for just this for 9 months. We're gonna raise, and then we're gonna deploy all that money over a 5-year period. We call that a closed-end fund. That's pretty normal and very similar to a syndication. What's a little different is when we're structuring it to be more like what we call an open-ended fund, which looks more like a mutual fund. You have investors coming in, you have investors going out, and we're always having to reprice our assets in order to make sure we're not, diluting the early investors when later people come in. So those get more complicated, really more for the syndicator than for my side, because they have to start figuring out, well, how am I going to calculate that asset values? I just have to describe it. So for my part, it's not so bad, but I certainly, kind of coach my clients through that that process to make sure they've got a good mechanism.
How, if you had to guess, just percentage of your business, syndication versus fund?
Right, it changes all the time. So the balance changes. So I would say right now it's probably about 30% like single asset, like a syndication, versus 70% more funds.
Okay,
That, you know, you asked me that question 2 years ago, it would have been exactly the opposite.
got it. And is that, do you see that kind of as a, like you said, ebb and flow? Is that kind of more reflective of the current market?
It's market. Yeah, I mean, there's in general in real estate, I mean, most areas are having there's less product on the market, and so people are getting more creative about packaging, and we're certainly doing more, debt funds where we're helping, people raise money for hard money lending or things like that, which tends to be more like a fund. So there, it's just the market forces, and at the end of the day, the regulation D is so flexible. We can really tailor these things to be really anything that's legal, we can make it work, right? We can make it, we can put it under regulation D as long as it's a legal construct to begin with. And so that gives us the ability to kind of adapt to market forces at any given time.
Got it. And as far as the operators or the syndicators themselves, as long as you've been doing this, is there any kind of a, I don't know if it's a test or is there any kind of a qualification experience that you've seen as a common denominator amongst them for being successful at syndicating?
Um, Not really. I mean, I've thought about that that before, and there's nothing that's really strong throughout. I mean, it's got to be somebody who's got a big idea that they want to do this. They're not afraid of asking people for money, and they're gonna make it work. Um, I guess so. I guess the biggest person is they're kind of brave because you've got to have some chutzpah to go out there and ask and talk to investors about money. And there are also people who are pretty adaptable. So things come up, especially in your first deal, always. There's always the deal never looks exactly like it does at the end from when you first thought about it in the beginning. So you've got to be pretty adaptable and be willing to kind of steer the ship slightly when it needs steering. So I guess those are the two traits that are most commonly there, but it's not like, oh, these are hardcore developers or these are financial geniuses or these are the best salesmen. Those are all, they all exist and they're all part of my client base, but they're not even the majority.
Yeah. Well, and even along those lines, you kind of described yourself as your partner said, "Hey, we should syndicate this." Had your partner ever syndicated anything prior to that?
No, he just thought it was a good idea. He had
Yeah.
been in a syndication before, and he was actually really unhappy about it because they weren't communicating with him, and he didn't really ever know what was going on. Um, and I kind of knew that backstory a little bit, and that was kind of like why we got along so well was we're both very like investor first. We whatever the investor needs to be happy, that's what we do. Um, and so that's why it was kind of a natural partnership from the beginning.
Yeah, no, I think that's kind of one of the things that I've heard over and over again is, it's one thing when everything's going well, but when things the seas are choppy, uh, communicating and keeping your investors, aware of what's going on so there's no surprises, tends to smooth out a lot of the
Yeah, and
potential.
that's always my advice. As soon as when we get into those rocky situations like we talked about before, it's my answer is always like, well, what have you told them? Have you
Yeah.
picked up the phone and told them? Have you talked to them? People don't
Right.
make. I mean, I've seen clients. of mine lose investor money, like lose it all. And the investors at the end of the day, generally, it doesn't happen a lot, but maybe 2% of the time. And when it happens, the investors are very disappointed, but they're not angry because all along the way they've been told this is what's happening, this is what's happening, this is what's happening. If you know what's going on, you're probably not going to be angry about it. You're certainly going to be disappointed because nobody wants to lose money. Uh, but that makes you more of like a team, right? Your investor and your syndicator are functioning more as a team. The syndicator wants to make money too. He wants a happy investor. And the more they communicate, the more they're like, I'm in the same boat. We're doing everything we can to make the money.
Yeah. No, it's an interesting kind of opportunity, and for people that are unaware of syndications to get comfortable with and understand the structure and the opportunity. Um, I think that I've always been kind of amazed at the number of people I talk with that are not aware that that's not an option.
Yeah, yeah,
Um,
totally.
it's just as an investment vehicle, and even though they're qualified but just getting the word out, and also I guess there's a level of comfort. You're dealing with a registered public security is a name you've probably heard of. There's a structure there with the broker dealers and all that versus kind of trusting an individual and understanding that what they're offering and how they're going about it. And I think in the last, what has it been, 15 years now that this has been um, a deal that
Yeah,
there's certainly it's becoming more of a known than an unknown.
you're right.
Uh, but still, it's you know I would say the majority of people are not participating or unaware or not interested, kind of thing. Except for the people that really are looking for something are starting to find it and hearing more about it. So good.
Absolutely.
Hey, Tilden, if we could, I'd like to shift gears here for a second.
Sure.
I mentioned to you before we started. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we're not able to avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, their investors, the market, laws, public sentiment, whatever it might be, that you consider to be the biggest risk. And
Mhm.
again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Tilden Moschetti, what is the biggest risk?
I'd say that it's lack of communication. So, and that's, which is unfortunate because it's also the easiest to fix, right? So, lack of communication will lead to failure to identify risks, whether it's, the kind of risks we think about in the insurance game, like, fire and hazard risk, right? We know those things are there, but communicating with your property manager, communicating with your tenants, communicating with those kind of people can all help identify, hey, yeah, and by the way, the sprinklers never work when we do the testing, or whatever those things are that can help reduce that risk. But certainly in my world, things go bad when you don't talk to people. So if I could have the best deal in the world, send people their regular checks, but all I'm doing is sending them money, and if it just looks like a black hole, then investors are always going to be thinking there's something wrong. I don't have any kind of transparency. I don't understand what's going on. Maybe this guy is ripping me off. Where it could be completely not true. But if I don't communicate, there's no way that they can ever know. And so I'd say by far, almost every risk kind of boils down to that lack of communication, or at least communicating a lot and really kind of understanding and listening and talking and kind of figuring out what's going on any kind of asset is going to, at the very least, reduce that risk or help you identify it or help mitigate it in some manner.
Yeah, no, well said. On that line, I'm curious, is there anything that you are able to discern or recognize up front when working with a new prospective client or new client as to their level of communication?
I'm sometimes surprised when I find out communication isn't going on to the level that that I think investors are expecting. So most of the time, my talk, what I'm doing when a client hires me, it's what's your communication plan look like. I structure my documents around in a way that always invites communication back in. I've never had a client like tell me not to. I've had people want to remove names or something like that, but I've never had anything where they didn't want the phone number or they didn't want the actual communication there. So I do the best I can to kind of encourage it. And then it's always, if anything comes up, it's always, talk to your investor, talk to your investor, talk to your investor.
Yeah. No, it's funny, the whole nature of communication. Some people are, well, once you get to a group of people and the need to essentially hear them out, I find that there's a lot of patience involved. A lot of times the answer is the same as it was to the last person I told, but the other, everybody else has to ask the question, the same question, but from themselves, or
They'll
depending
feel
on.
much better if they ask, if they get to do the asking. So
Yeah.
you should always encourage it because
Right.
it just
Right.
keeps
But yeah, but just the patience required to kind of just hear them out and, understand it's a process. And I think, a lot of times the communication for all of us, there's an ability to process whatever the information you have by communicating, and get to a level of comfort with it. So,
yeah.
but anyway, hey, Tilden, where can the listeners go if they'd like to learn more or connect with you?
Best way to connect is my website, moschettilaw.com. Also, I've got a YouTube channel that's got quite a lot of videos that go through, these technical legal topics. Then hopefully they're really helpful to kind of give people just general information before they even think they may want to get started.
Got it. Well, Tilden Moschetti, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thanks. I really appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.